Hi, today let's talk about the short squeeze, which, if you're caught up in it, will result in massive financial losses for yourself. So, as a reminder, if you believe a stock is overvalued or for whatever reason you think the stock price is going to go down, you can borrow that from somebody. You're going to pay them an interest rate on that borrow. You're going to go to the market, you're going to sell it, hoping that the stock goes down. Then you can buy it back, and then that differential is your profit here. So that's one way to kind of capitalize on price decreases in the market. So I have a video that goes into that in more detail if you follow this link right here. Now, if I think about kind of GameStop and AMC, I have some videos on them, and you can check out that video if you follow this link here. But in that video, basically say that fundamentally these stocks were and still are quite bad, and the price increases in them were totally unjustified, creating this kind of perfect environment to short those stocks given their fundamentals. So you could be totally right, but it doesn't preempt you from getting a short squeeze, which is what a lot of players out there in the market found themselves in. Some very successful investors were short squeeze here. So what are we talking about here? So the idea is you've decided to short a stock because you believe it is overvalued for whatever reason, or it's going to go down for whatever reason. But for some reason, the stock price goes up. So there's some news regarding the company. They make some announcement about a new product or a new venture, or for whatever reason, there's some Reddit subgroup that decides that they like the stocks or whatever. For whatever reason, the sentiment goes up, or there's just crazy investors who have no idea what they're doing and are just following some bandwagon. But for whatever reason, that stock price goes up and you have it shorted. So the problem there is that as that price goes up, the paper value of your position goes down and down and down and down. And as it goes down, it gets less and less profitable to the point where it becomes totally unprofitable, et cetera, et cetera, et cetera. But you have an arrangement with your prime broker. This account's on margin, and at some point they're going to say, look, we can't allow you to hold this position, so you need to buy the shares back and just eat that loss. Now, everyone has their own breaking point. Everyone has their ability or not to continue to fund that margin account or whatever, but at some point everyone has their breaking point. So let's think about what it's like when you are shorting a share. So when you short a share, you're essentially adding to the supply of those shares for people to buy, which just your actions alone of that shorting do drive the demand or increase the supply for that share, and then thus lower the price of that share. So just your actions alone help to contribute to the price decline. Now, when there's some announcement or whatever, there's some reason for whatever, this stock price, this news goes up and the demand increases because some people, the news is good, or people jump on a bandwagon or whatever it is, because that jumps up, that demand, then the price also jumps up. So for you, that's not good. It's moving in the opposite direction. Now, at some point, you reach your breaking point. You need to then buy back some shares, so that it further increases the demand for those stocks, further increases the price. Someone else gets triggered in terms of their breaking point. They now must buy back shares, increasing the demand. Boom, price goes up again. And this just continues. This is the short squeeze, where your people are buying because they're losing money, and that's artificially increasing the demand and increasing the price of those shares. Now, some historical examples here. In 08, Porsche was buying shares of the Volkswagen, and it caused the price to really shoot up there because they held such a controlling interest in Volkswagen. Because of this big price jump, leading up there were lots of short sellers. In aggregate, short sellers lost $30 billion because of this short squeeze, even though the price subsequently kind of declined to this pre-Porsche purchasing of Volkswagen shares. Tesla, famous example here, so we can see with the orange line here, short selling, short interest, and with the green line, we can see the price here. And clearly you can see that these things went in the opposite direction. You can see some big jump down in the short interest due to some of these prices. You can definitely see that squeeze there. Now, again, I say, even if you're right, this can happen. Now I have a video here where I think, Tesla's a great company. I think they can do beautiful things, but they are grotesquely overvalued. And at some point, this is all going to come crashing down. Timing is notoriously difficult. I have no idea how and when that's going to play out. But I think looking forward, 15 years, we're going to see that Tesla is a stock loser, even if the company does tremendously well. During this short squeeze, shorters lost collectively about $8 billion. Another example here with this Kalobios. There was the stock skyrockets. People are getting killed. A trader, famously did a GoFundMe to try to cover himself here. But the news wasn't really real here. There was nothing really material that caused this, and subsequently the stock price goes back down to where it was. But there was this very short period of time, a lot of short sellers got killed in the market. As I said before, options are a safer way to have this view of a stock going down because you don't have these problems such as unlimited losses. You can see a lot of videos regarding stock options if you follow these links here. Next time we can talk about different ways of measuring how much short interest is out there in the markets. I'm Brian Kozlowski. I hope you enjoyed that. Thank you so much.